Welcome, everybody. My name is Kristen Biermeyer. I'm the marketing manager for Wegner CPAs, and I am so glad to have you all join us today for our year-end tax update. The presentation is being recorded today, and I will email it to you along with the slide deck after today's event. Feel free to submit any questions you have during the presentation through the Q&A feature at the bottom of the screen. We'll leave some time at the end of the presentation to answer any questions that come in. Our presenters today are John Folsom, Kent Collier, and Rich Lee, all from Wegner CPAs. With that, John, I will turn things over to you.
All right, thanks, Kristen. Welcome, everybody, to our annual year-end tax update here. We tend to do this every year, and it's always a little difficult to try to pick and choose which topics we think are most important. So one thing I'll say up front is this particular webinar is more geared towards business owners than individuals, but yet there's so much that can apply to individuals too. So we do have some stuff that relates to individual income tax. So these are the four main categories we're going to talk about today. It actually was a fairly quiet year as far as tax legislation. If any of you recall, about approximately a year ago, Congress was trying to get something passed called the Build Back Better plan, and I think it actually passed the House, but then it did not pass the Senate. So that nothing ever happened with that Build Back Better plan. But then this past August, all of a sudden they agreed, they came to an agreement, and it was a lot different than the Build Back Better plan, but they call it the Inflation Reduction Act of 2022. So we'll spend a little bit of time on that. Rich is going to go over some what we call general tax updates for both individuals and businesses. And then we do have some other topics that aren't necessarily income tax related, but they are very important for our business clients. One of them is the employee versus independent contractor rules. It's been kind of an ongoing battle between a lot of workers, especially in this economy with they call it the gig economy, a lot of independent contractors, Uber drivers, and things like that. How do you know when somebody's your employee versus an independent contractor? And then the last item, there is something going on with the state of Wisconsin, and it relates to this concept called unclaimed property. So we are going to spend a little bit of time on that. So we'll start with the Inflation Reduction Act. Actually, we're going to start with a little humor. I've been kind of a fan of this Dave Barry for a number of years. Maybe I'm dating myself. He was a columnist. I'm assuming he still writes, but he was probably popular in the 80s and 90s and early 2000s. And he actually had a lot of really good income tax quotes. So we sprinkled in a few of his quotes here today just to make things a little bit more interesting, because anytime you've got accountants giving a webinar right after lunch, we need a little bit of a humor to spice things up. So the Inflation Reduction Act. And first of all, don't ask me why they called it this, because best case scenario, they said it probably won't have much impact on inflation. I mean, some people claim that it could longer term have some impact on inflation. Primarily the driver, though, when you look at what's in this bill, it was not really inflation related. So that's just kind of politicians being politicians. It was signed into law on August 16th of this year, 2022. And surprisingly, as far as when I think about our client base here at Wegner, a lot of the stuff they put in here probably doesn't apply to a lot of our clients. It was a close to 300-page bill. And so there's all kinds of stuff in here. Some stuff, can apply and a lot doesn't. So just mention a few of the big things. They wanted to raise some revenue here. And one of the revenue raisers they put in was this concept of this 15% corporate minimum tax. And before that scares anybody, it only applies to corporations with at least $1 billion in financial statement income over, I think they look at the average of the past 3 years. So I'm pretty confident in saying that none of our Wegner clients have $1 billion or more in financial statement net income. So that won't apply. The other one is a new 1% excise tax on corporate stock repurchases or redemptions or buybacks. That again only applies basically to publicly traded companies. So that won't apply to any of our clients as well. The one thing that's really gotten a lot of press is this IRS funding, and that was part of this Inflation Reduction Act. So again, they're trying to find, well, let me back up. They're they're trying to find ways to raise revenue to offset some of the spending in this bill. Spending is primarily related to energy type things, and so we'll get into a little bit of that. But this whole concept of the IRS funding, and they did allocate about $80 billion in IRS funding. And like I said, this has been getting all kinds of press, and people are all up in arms about this, and that, everybody's going to get audited, and, they're hiring 83,000 IRS agents, and, people are freaking out because they're hearing all these things that, like, oh, they're all going to be armed and stuff. It's going to be this army of IRS agents. And, so what's true in that and what's not true? Basically, it is true that the plan is to hire 80-some thousand new IRS employees. However, a lot of that is simply replacements, because they are predicting over the next 5 years that the IRS could lose easily 50,000 of their current employees to retirements and just turnover. So a lot of it's just going to be replacements. If you hear about IRS agents being armed, it's a very small percentage of IRS agents that actually carry firearms, and it's usually they have a criminal division, so they're going after the drug dealers and the money laundering people under the criminal statutes. So again, you're not going to see an armed IRS agent, so don't worry about that as well. So the funding, the $80 billion here, it breaks down essentially as follows. They call it taxpayer services, 3.2 billion. Enforcement is 45 billion. So the majority is enforcement. They do want to try to find people who are not reporting the appropriate amount of tax and go after that. And then operations support and systems modernization. And Rich is going to talk a little bit about some of the problems the IRS has been having. And I don't know if any of you have tried to call the IRS or anything lately, but it's been very difficult. So I won't steal Rich's thunder on that, but that's in this Inflation Reduction Act. So what else is in here? There's some things in here that are important to some people, and some are fairly insignificant. But one thing is this healthcare premium tax credit for anyone who files their individual income tax return and they get their health insurance through the marketplace. They can get this what's called a premium tax credit. And before COVID, there was kind of a cliff where if your income was over 400% of the stated poverty level, it was like you wouldn't get any credit, or you wouldn't get any assistance with this healthcare. So this Inflation Reduction Act, they extended the funding for these subsidies, and then they also extended this temporary exception that came out of COVID to actually allow people, a little higher income people, to still get at least some credit. The second one here is this expansion of the federal research credit, and that can be used against payroll taxes. And so what's that all about? The federal research and development tax credit allows for smaller companies in certain situations to be able to, instead of just getting the regular income tax credit, they can actually apply that credit against payroll taxes, Social Security and Medicare. And that's been the case here for a little while. What's changed is that they're just increasing the annual amount that you can use against that. So that's what that's about. And then the last bullet point here, investment in green energy. And so it's kind of the last bullet point here, but that actually was one of the major funding areas of this bill. And a lot of it in the bill relates to energy producers. If you're a municipality and you want to set up, energy type things like charging stations and stuff. So a lot of it's more at that level, like producer type level. There are some things that apply to business and individual income tax payers as well. The first thing I'll talk about is this. It's called the Energy Efficient Home Improvement Credit. And this has been around for a while, and honestly, it's been largely ignored because there's a lifetime limit on this credit as it stood before this act of $500. So over the course of your lifetime, you could take up to a $500 credit for this kind of stuff. Well, this Inflation Reduction Act now changes this credit. It makes it a little bit more valuable. It's effective, starting 2023 now for next year. It increases the credit from 10% to 30% of the improvements. And there is a dollar limit. It's instead of a lifetime limit of $500, it's actually an annual limit of $1,200 now. So it makes it a little bit more valuable. It relates to things like home improvements. They call it qualifying energy property. It can include things like energy efficient windows and doors and things like that. It also can apply to certain like furnaces or gas pumps or heaters, things like that. The third bullet point here, which I didn't mention yet, is under the old law, these things had to be placed in service on your principal residence only. And now the way this new law is going to be starting 2023, if it's an improvement to any home you use as a residence, it'll qualify. So if you have two homes, if you have a home in Wisconsin and a home in Florida, and you make improvements to both of those homes, you can take this credit on either home. Whereas in the past, it would have to be, you'd have to only, be able to take that on your primary residence. And there's some little other limits in there as well. There's I think there's a $600 limit for windows. There's a $250 limit for an exterior door, things like that. So there's more detail behind this. And I think, having said that, a lot of the stuff we're talking about today, we're trying to just hit the high level things that are changing this year. We're not going to do any deep dives into any one of these areas just because we don't have the time. The other one here is called the residential clean energy credit. And why do they differentiate these two types of credits? I don't really know. I think that's just the way that the tax code evolved. They've got two separate credits. The one is under the one code section, and then this is under code section 25D. This residential clean energy credit really is the most common thing we see as our clients. They're purchasing solar for their homes, basically, like on the rooftop solar panels. That's what this is. And this was supposed to fall to 26% for the 2022 tax year. This Inflation Reduction Act changed that to 30%, starting right here in 2022. So it's back to 30%, and it's going to stay at 30% all the way to the years 2032. So for the foreseeable future here, there's going to be a 30% tax credit available for home solar installations or business. If you have a solar installation on your business property, your office building or something, that can qualify too. And then one of the big things that's really popular, obviously, these days are the electric vehicles. So what's going on with the electric vehicle changes? There are significant changes in the EV credits here. And so I'll try to break that down here, and hopefully this will make sense. So they've changed it. A lot of the stuff is changing for 2023. So a lot of what we're showing here are things for vehicles purchased in 2023. The credit is up to $7,500 for new vehicles, and there is no longer any caps on how many vehicles are sold. Under the previous law, once a manufacturer hit a certain number of units sold, like I think it was 200,000, then the credit went away. Well, starting in 2023, there's no longer any cap. So it doesn't matter how many Chevy Bolts that are produced. They could make 1 million of them, and everybody would still get the credit for that. The big thing here, and the interesting thing that I found with this new Inflation Reduction Act on these EV credits is this final assembly must be in North America, Canada, United States, Mexico. And so right there, that actually eliminates a lot of these electric vehicles from even applying for this credit. And the one thing I want to make a note of is this final assembly thing in North America, that actually applies back to the date of this law. So the Inflation Reduction Act was signed on August 16th. So if you went and bought an electric vehicle in September of 2022, and if it's not, if the final assembly was not in North America, you cannot take that credit for 2022. So that's the one part of this law that applies to the tax year 2022. All the other rules for the EV credits for 2022 are the old rules, 2022 rules, but the only one that changes for 2022 is the final assembly in North America. So I hope that makes sense. I know I kind of went through that, but then everything else we're talking about here starts in 2023. And in 2023, there's what they call sourcing requirements. So again, what I said before, one of the interesting things is this whole concept of, made in North America. And not only final assembly, but also the sourcing requirements for the battery components. The $7,500 credit is actually broken up into two halves. And so there's this this requirement that the battery or the critical minerals for the battery has to be made in North America, and then the other battery components also have to be made in North America. So you potentially could get a $3,750 credit instead of a $7,500 credit if one of your vehicles met one of those and not the other. So again, you're gonna have to go to the manufacturer. I'm guessing that if anybody's going to qualify, most of the time it's probably going to be the full 7,500 or nothing, I'm guessing. The one thing that's also interesting in this is that they're trying to prevent rich people buying really expensive cars from getting these credits, which I think for a lot of people probably makes some sense. So there's these sale price caps, this MSRP caps. So if your electric vehicle is a van or a truck or an SUV, if it costs more than $80,000, you can't get the credit. For a car, it'd be $55,000. So some of these electric cars, like the Lucid and some of these really expensive cars that cost $100,000 or more, those will not be available for the credit. The other thing here is the income caps for the taxpayer. So if a married couple is earning more than $300,000 a year, they will not be eligible to get any more EV credits. So those are some of the big changes. Another very big change is that the credit, or there is a credit potentially available to used cars as well. In the past, it had to be a brand new car. So starting in 2023, used vehicles might qualify, and the credit would be the lesser of $4,000 or 30% of the price of the vehicle. And then there's all these other things. The price of the vehicle must be under $25,000. So I know it's difficult to find any used car under $25,000. It must be at least 2 years old, and it has to be sold by a dealer. And there's some income caps there for these used vehicles as well. It's $150,000 for married filing joint, $112,500 for head of household, and $75,000 for single. And then lastly, there is still a credit for if you have a home, put in a home charger, you can get up to $1,000 tax credit for that. So a lot of changes with the electric vehicles. I know electric vehicles are very popular. I think with this whole sourcing thing, with this final, but between all of them, the final assembly in North America, the vehicle MSRP caps, and the income caps, I think that there's going to be a lot fewer either vehicles eligible for this or people eligible to be able to claim these credits as there was in the past. So on the one hand, it seems like they're making it easier and more lucrative to get these credits, and on the other hand, it seems like they're making it a little more difficult. So I thought it was kind of an interesting thing that this whole Inflation Reduction Act, a lot of it was this energy stuff to promote clean energy and green energy. But then at the same time, it was interesting because they really wanted to push the Made in America kind of thing too. So I'm not going to comment one way or the other what's right or what's wrong. I just think it was interesting that's the way it evolved under the law. So I think at this point, I'm going to pass this over to Rich. And before we do that, I'll just throw up one more quote from Dave Barry that I enjoy. So he talks here about the mistake of not being a large industry that gives humongous contributions to key tax writing congresspersons. So again, I enjoy Dave Barry, so thought we'd just share a few of those. So Rich, I will turn it over to you, and I can just keep moving these slides if you want.
Sure. Thanks, John. Good afternoon, everyone. I'm Rich Lee, tax manager at the Madison office here. Going into my 10th year, so I focus mainly on pass-through entities, their shareholders, high net worth individuals, and then during the off season, I tend to help out the not-for-profit clients with their 990 reporting. So today, just going to give you a general tax update, both on the business side as well as the individual side. So there's an overarching theme here with the IRS. It's kind of COVID's been really tough with the IRS. It's twofold with paper filed returns. Starting March of 2020, pretty much everyone in the IRS buildings and whatnot were sent home, and it was just a huge buildup of paper filed returns that were just sitting there for months on end. And if you look at 2021, as there was about 20 million of unprocessed paper returns, and as of 2022, we're heading into 21,300,000 of unprocessed returns. So what does this mean for you? A lot of it is really any kind of paper filed returns that you have. Chances are, if it hasn't been processed, the addresses, the names, anything like that hasn't been updated. And for a lot of our clients, this also means refunds hasn't been issued if it's a paper filed return. So just something to keep in mind. We're hoping that this eventually will calm down and RS will eventually catch up, but stay tuned. As far as another thing that for some of our clients that like to call the IRS themselves, or especially for CPAs and tax practitioners, it's the amount of times that you call the IRS and when do you actually get through. So our hit rate, I think as a nation, is about 10%. What does this mean? Typically prior to 2020, sure, there usually is a 30 minutes to an hour wait sometimes to get through to the IRS. Whereas for the last 2 years and a half, sure Kent and John might have also faced this. When you call the IRS, a lot of times once you get to the department that serves your specific return, say 1120S or 1065, a lot of times you'll get a voicemail pretty much saying that there's high volume and to call back later. So there isn't even an option to wait. So just something to keep in mind if you ever try to call the IRS or if you have your CPA call the IRS, that's the reason why sometimes it might take a while to clear up any kind of notices and whatnot. As far as general tax updates, we'll touch on the gift tax and estate tax first. So last couple of years, inflation's been the big theme, right? So what does this mean? A lot of the numbers have been dramatically moved up for 2023. So in 2022, the annual federal gift tax exclusion was $16,000 per recipient, whereas 2023 has been increased to $17,000 per recipient. As far as the unified lifetime federal exclusion, it was in 2022 it was 12.06 million. 2023 there was a dramatic jump up to 12.93 million. And all of this bigger number was really changed back in 2018 with the Tax Cuts and Jobs Act. And a lot of those rules and legislations that were passed in 2018 have sunset. So what does this mean is that in the next 3 to 4 years, a lot of these rules that were changed back in 2018 will actually revert back to what it was prior to 2018. So prior to that, there was a 5 million federal exclusion, and this index for inflation will be approximately 6.4 million as of 2026. And this is obviously if the current law remains. The last few years, it's been a lot of back and forth, a lot of talk about things passing through, but then it just hasn't been able to get either bipartisan or any kind of leverage in the government to pass through. So one thing that's really going to affect a lot of sole proprietors starting in 2022 is this 1099K reporting. So typically what this means is if you receive a payment via debit card, credit card, PayPal even, prior to 2022, if you had over 200 transactions or in an aggregate of $20,000 of transactions, then you might receive a 1099K from either the credit card companies like Visa or whatnot. But starting in 2022, this number has really dramatically been reduced. So now a single transaction exceeding $600 can trigger a 1099K. So what does this mean for you as a sole proprietor? If you have gross receipts and you already use a bookkeeping system like QuickBooks or whatnot, and you have gross receipts of 20,000 or say more, they might not really be a big deal for you, since that whatever is reported on the 1099K is you're already including in your gross receipts anyway. what you might see is just more of these 1099Ks coming through. So I think a lot of it is really the fear of getting another IRS form and what does this mean. So hopefully not a whole lot, but some things to keep in mind is, say if you have an antique or something that you've had for years, and for some reason you're able to sell it for $600, $700, that might mean you'll get a 1099K and there might be tax implications. So if that's something that occurred, definitely talk to your tax advisor when you do your tax returns. If that's something new that wouldn't have happened prior to this year. Some retirement plan contribution limits. This is both on the business side and also on the individual side. So again, this goes back to inflation. For traditional and Roth IRA contributions, it was $6,000 back in 2022, and prior to that, for about 4 or 5 years, this number hasn't changed. With inflation going the way it is, for 2023, it was raised to $6,500 for both traditional and Roth IRA contributions. If you're over the age of 50, you have another catch up of 1,000, and this 1,000 remains the same for 2023. As far as 401k and 403b employee contributions, this was $20,500 in 2022. It was raised quite a bit to $22,500 in 2023. And also for anyone that's over 50, the catch up for 401k, 403b has also been raised. It was $6,500 in 2022. It'll be $7,500 in 2023. Lastly, a couple more. SEP IRA contributions grew from $61,000 in 2022 to $66,000 in 2023, and simple IRA contributions grew from $14,000 to $15.5. One thing that will probably affect a decent amount of our business clients, that especially ones that have research and development expenses, is that starting in 2022, with the law as the way it's now written, instead of being able to deduct that entire R&D expenses, now you have to amortize it over 5 years. So what does that mean? It's typically, say if you have $1 million of R&D expenses prior to 2022, you can expense all of that for book and tax purposes. Whereas starting in 2022, as the law stands today, now you have to amortize it for tax purposes. So say if you have $1 million, it'll be actually amortized over 6 years, because the first year you can only take half of that. So there's been a decent amount of talk in the Congress about this being kind of reverted back to the 21 laws, where everything can be taken, and hopefully there's bipartisan support. But as we all know, with the government right now, anything that hasn't been passed, I wouldn't bet on it passing. I would count on just the current law being the law until you actually see something passed through the legislation. Few more general business tax updates. Section 179 expensing limit for 2022 is $1,080,000. Bonus depreciation remains 100% for 2022, but again, that's part of the TCJA sunset. It'll get reduced to 80% in 2023. It'll reduce by another 20% every year until it's 20% in 2026. Something that was, as far as meals entertainment goes, during COVID, there was really a push to get people back into restaurants, to stimulate the restaurant business. And one of the ways to do this was that allowed 100% expense for any kind of meals provided for business that's bought from a restaurant. So that was for 2021. And again, that will also be for 2022. So think about it, anything that you're buying with clients, employees, or whatnot, if it's bought from a restaurant, you can take 100% expense on that in 2022. Entertainment expenses remains 100% non-deductible. So back in 2018, this was a big change from prior laws where you think of one big thing is box seats at Kohl Center or Pfizer. That used to be 50% deductible, whereas starting in 2018 on, it was 100% non-deductible. So that's an add-on for your tax returns. Just going back to the meals, that 100% expense is really just for restaurants, to stimulate restaurants. So if you think about it, if you stop by Quick Trip or 7-Eleven and you buy some food that might be related to your business, that still remains at 50% deduction. So you can't take 100% on that. A couple more things to keep in mind for W-2 reporting. Don't forget that for anyone that's a 2% shareholder, greater than 2% shareholder of a S Corp, you have to add your health insurance onto your W-2. Any kind of personal use of company-owned autos should be reported on the W-2. And there's a pretty good IRS publication, 15B, that talks about all the fringe benefits and what should be included and what shouldn't be included.
And I'll just mention on that S Corp health insurance thing, it's not that you're gonna, not be entitled to the deduction for the health insurance. It's just a reporting mechanism. So how it works is the health insurance that your S Corp pays for your health insurance as an owner, it does get added to your W-2 as additional compensation. But then on your individual tax return, your Form 1040, then there's a line where we subtract it off as self-employed health insurance deduction. So it's by adding it to the W-2, it's not saying, well, now you're going to get taxed on it, because it's, at the end of the day, it's still a deductible. It's just the mechanism for how the IRS requires it to be reported. So yeah, you have to jump through those hoops, but you're not getting taxed more on that. So, and then like Rich said, that publication 15B is actually really good. So anytime you're offering any employees any kind of fringe benefits, education benefits, or anything, what's the taxation on that? That publication 15B is actually really good. I think every controller, every HR person should have access to that, to just kind of read through that to understand how that works.
Well, and just to add to S Corp health insurance, even though it's an in and out, that's the only way to actually get that deduction. So it's, a lot of people just say, oh, well, it's an in and out, so it doesn't matter. I forgot to put it on there. Well, if you actually get audited, you'll get that deduction denied, because the only way to get the deduction is to actually show it in and out. So even though it's a net nothing, it's still important.
Exactly.
Sure, just a couple more things on the individual side. So in 2021, a couple things that really hit the news were the child tax credit, as well as the child independent care tax credit. So in 2021 and for 2021 alone, that child tax credit was raised to $3,000 for anyone under 6, and $3,600 for anyone under 6, and $3,000 for anyone between the age of 6 to 17. This has reverted back to $2,000 per child that's below the age of 17 in 2022. The bright side on that is the income threshold has really been raised a lot. It was $400,000 for modified adjusted gross income for anyone that's married filing jointly, and for all other filers it's $200,000 and modified AGI. So, and this is another item that you might want to stay tuned for. This has been hitting the news pretty hard for the last month or so. President Biden is really trying to negotiate with both sides of the party to get the 2021 limit to be again repeated for 2022. So he wants to get the $3,000 tax credit for anyone that's between the age of 6 to 17, and $3,600 for anyone under 6. So stay tuned on that. hopefully we'll hear something within the next month or two if it gets passed. But I mean, in the end, I believe we have till April. And another thing that was really a huge benefit to a lot of people last year is anyone that's sending their kids to daycare. Daycare expenses are pretty high these days. Last year, for certain bands of income, taxable income, folks can deduct almost up to 50% of their expenses. And that expense was typically in a normal year, it's up to $6,000 for 2 or more kids. Last year in 2021, that was raised up to $16,000. So as you can imagine, 50% of $16,000, that could have been an $8,000 tax credit on your personal 1040. So that was a pretty big deal last year. But as of right now, that has reverted back to the 20 to 35% based on your income of either $3,000 per child or $6,000 every two kids or more. So if you think about it, 20% of 6,000, that's dramatically lower than what it was in 2021. Lastly, for states, Wisconsin is one of the states that allows a deduction if you do contribute to a child's 529 plan. So through AdVac, that's typically the one that's being used the most. The deduction for 2022 is $3,560. And for the 529 plan, as well as your Roth or traditional IRA, one thing to keep in mind is that you can do this up till tax day of filing date. So say for your 2022 contribution, you can make that contribution up till April 18th of 2023, since that's what the tax day is.
Basically, my only comment on this slide would be that, you know, some of our clients who had large refunds or had very little tax to pay last year on their business income, you know, it may be because you receive large tax credits for your children, and if those are not on the same level, you know, your refunds are going to be much smaller, or, you know, your tax will be what it would have been without these credits. So another push to get your information in early so you don't have an unexpected bill in April. At least, you know, if you're going to get it, at least you know about it in February as opposed to April 15th, and you have to pay by the 18th.
Yep. All right, thank you, Rich. Another one of my favorite Dave Barry quotes: "We'll try to cooperate fully with the IRS because as citizens, we feel a strong patriotic duty not to go to jail." And I think I can confidently say we've never had our clients go to jail either. So I think I'll turn this over to Kent to talk about the employee versus independent contractor issues.
So my name is Ken Collier. I'm a manager here at Wagner CPAs, and I work with primarily with John in our construction and real estate development niche. So for employees and independent contractors, there was a proposed rule, there was a rule in 2021 that was passed kind of at the end of the Trump administration that kind of went from our old rules of these 6-nature test down to more of a abbreviated rule, which basically said, you know, there's kind of 2 core factors of what to consider between the employees and independent contractors. And they're basically just the opportunity for profit and the locus of control of who, you know, do you really have control of this independent contractor, and are they really an employee, or is it a true subcontractor or independent contractor where, you know, they're really their own separate business. So, you know, and that was, you know, this whole scenario is really highly debated right now. You know, I'm sure many of you have heard the ABC test and the state rules about, you know, is Uber really a platform for doing businesses, or is it really a ride sharing company? So So the six rules that we're the six proposed rules that we're kind of going back to is one, does the employee have or does the contractor have the opportunity to profit? Meaning, are they being paid by a job basis, or are they paying by the hours or by something of that nature? The second one being, are the investments by the worker? And do they bring their own supplies? Do they bring their own machines? Do they kind of have the opportunities? Are they in business for themselves? The third degree would probably be what is the nature of the working relationship? Are your independent contractors your only independent contractors and they work for you full time and you have control of when they work and how they work and things of that nature? And then for the nature and degree of control, again, you have control of when those hours are being worked. Are they reporting to you on a timely basis? Either that written or oral reports. And then 5, this is the point that really some of that bows out a lot of the options is to the extent of the work is that you're an integral part of the business. And that's where some of these large gig economies, the Ubers, the instant carts and things of that nature are really kind of failing. And that was the main piece that the 2021 ruling kind of intercepted was, is Uber a ride sharing company, or are they a platform to share? And if they're not if they are a ride sharing company, well, then really the drivers or the delivery drivers are what the business is. And that's where you fail on a lot of that aspect. And then finally, the skill and initiative of the employee / independent contractor. So obviously driving a car does not take a lot of skill and initiative. However, working in the construction industry, if you have skilled electricians, masonries, carpenters, obviously these people are in business for themselves and have the skills and initiatives to work. And then finally, what is the industry standard? So obviously in the construction industry, and many other industries, there are certain people who are subcontractors. So again, masonries, carpenters, those are typically subcontracted out there, their own businesses. Same thing with, like in the music industry, the bands are typically, that's the nature, and it's very common. All right. And John, there is a new slide here, right?
Yep.
There's only the one
Trying
slide.
to get to it here. There we go. Some links.
All right. So we shared for you a couple links here. So why is this important, right? You may ask yourself, why do you care if you're an independent contractor or if you are an employee? So you may be coming from the standpoints of whether or not you are an independent contractor or you're paying independent contractor. So for the employer or the person who is looking to get services from a subcontractor, it's somewhat beneficial to pay your people as independent contractors if they meet those tests. The reasons why, you don't have to cover them for workers' comp insurance, you don't have to cover them for unemployment, you don't have to offer benefits, you don't have to pay payroll taxes. There's a whole list of reasons of why it can be beneficial from a business standpoint to have independent contractors as opposed to having employees. As the employee and employee protections, it's exactly the opposite. As an employee, you don't have to pay for your own supplies. You don't have to, you lose your controls, but at the same time, your employer has to make you whole. The employer pays you benefits and things of that nature. So that's the whole reason of why this is such a highly, debated topic, and want to make sure this is, done well. So it is much as somebody who is doing the hiring, and as many of the business owners on this phone call are, it is much more, it is less risky to consider your people as employees and only to have certain independent contractors if you're able to meet these tests. And there's actually several different tests depending on who you ask. Of course, ask an accountant or a lawyer, the answer is always it depends. So we shared a couple different classifications. So there's the IRS, and they do a kind of common law test that goes through 20 questions that list different factors that will tilt you one way or the other of meeting these 6 rules. And are you geared more towards an employee, or are you more like an independent contractor? And it's really a facts and circumstances answer. There's no bright line test. In addition, I'm sure a lot of you on the phone call are from Wisconsin. So Wisconsin actually has their own kind of rules, not only for workers' comp, but also for unemployment. And as long as you make a good faith effort and treat your employees all fairly amongst the classifications, if you have some employees, there's some people that are treated as employees and some people that are treated as independent contractors, but yet their job status is really doing the same thing, that's not going to be well received at the state level. So I would say just do due diligence, make sure that you understand the rules, and make a informed decision on how you treat your employees. And I actually have seen a couple different clients receive audits by the DOL recently this year. Again, making sure you issue 1099s for this amount. What are the nature of these roles? Going through the audit procedures. Why do they consider independent contractors and not employees? And going through very fine tooth of what the answers are. So, and of course, if you do have an independent contractor and there are injuries on the job, obviously they're not covered under your workers' comp, and that could spell disaster if they were incorrectly classified.
Yeah, I think in our experience, whenever if you're an employee, if you're a business owner and you have somebody that you've been treating as an independent contractor, if it turns out that they get reclassified as an employee by one of these agencies, it rarely works out well for the business owner. I mean, there's back payroll taxes and penalties and potential overtime issues, and it's like Kent said, he's seen some of this come up recently, and it rarely works out well for the business owner if somebody needs to be reclassified. So it's important to look at these links. Are really good. So I would encourage everyone to spend a little bit of time just looking at those links. The first link, the DOL, that relates to this whole rule change, and it's a little bit more, it's a little harder to read. The IRS link is really good, and then the Wisconsin link is really good though too. So
yeah, and even disgruntled employees, if you have an employee who you always treated as an independent contractor, they leave for whatever reason, and they talk with somebody else and they tell them, oh, you really should have been an independent contractor the whole time. There's actually a whole form on the IRS on their tax return that says I was misclassified, and then they put who gave you the 1099, and if it should have been a W-2, you'll get some correspondence from the IRS.
mm-hmm. Yeah, and that's what attorneys are for. So all right, moving along, we have one more section here, and one more Dave Barry quote, and I like this one. Here's my proposal, which is based on the TV show Survivor. We put the entire Congress on an island. All the food on this island is locked inside a vault, which can only be opened by an ordinary American taxpayer named Bob. Every day, the congresspersons are given a section of the tax code, which they must rewrite so that Bob can understand it. If he can, he lets them eat that day. If he can't, he doesn't. So I like that one as well. But everybody always talks about the complexity of the Internal Revenue Code, and there's a lot of truth in that. It is ridiculously complex. So the last section we have relates to this thing called Wisconsin unclaimed property. And this is something that surprisingly a lot of people don't know about, or a lot of business owners don't know about. You can come at it from one of two angles. Either as an individual person, you can go on the Wisconsin website and look up to see, does the state of Wisconsin have any property of yours that you didn't know about? Like, someone, whatever, left you a bank account with $500 in it or something, and nobody's been able to contact you, and you can go claim that money, basically. The other angle, which we see, is from our business owner standpoint, so that if a business owner has property that they cannot find the owner for, the businesses are supposed to, or required to, file these unclaimed property reports with the state of Wisconsin. So file the report and turn over the money to the state of Wisconsin. And then the state of Wisconsin uses that website to try to track down the owner. So an example that comes up very frequently is if you're looking at your bank reconciliation and you have a lot of old outstanding checks that for whatever reason they were never cashed. So let's say you had an employee a while ago that you had done a $200 bonus check for. That employee is long gone. They're not an employee anymore. They never cashed the check. It's still sitting as an uncleared check in your bank reconciliation, over a year later. What do? A lot of businesses would be tempted just to reverse that entry and just keep that money, but that's actually against the law. So what you need to do is you need to, first of all, file a report. It's an annual report with the state of Wisconsin saying, hey, I got this, I'm a business, I have this bonus check to this employee who's I cannot find. I can't, they left the state, they left the country. I don't know where they live anymore. We owed them $200. They never cashed the check. So you have to report that, and then you also have to actually pay Wisconsin the $200, and then you can clear it out of your system. So a lot of business owners don't know about this. So this slide here talks about what is unclaimed property, and there's different things that they call dormancy periods depending on the type of property. So like my example was a wage check. I think the dormancy period for a wage check is 1 year. Other items have longer dormancy periods, like if it's a savings account at a bank, I think it might be a 5-year dormancy period or something like that. So the state of Wisconsin lists all these different types of property and what the dormancy periods are. And there are penalties for not doing this. So we want to make sure that our business clients know that this needs to be done, and there are penalties. And there's some really good resources. We're giving you some links here because we're not going to go into a whole webinar on the unclaimed property, but these links are really good. Wisconsin has this thing called Publication 82. It goes through all of this. What does unclaimed property mean? What are the different types? How do you do this? Where do you report it? When do you report it? How do you turn it back over to the state? So there's the whole homepage here. And then this last one here, there is a webinar that Wisconsin has on their website, this little holder reporting webinar. It's about a 45 or 50-minute webinar. So again, if you're a business owner, you should be listening to that webinar that's posted on their website, because it tells you everything you need to know about it. And the reason why we're bringing this up today is that there is something right now called a voluntary disclosure program with the state of Wisconsin, and it's effective if you apply for this voluntary disclosure program by February 28th of 2023. So we've got 2 months now that you can still apply for this. And so if you do this, if you meet the requirements, which you have to, if you've been audited the last number of years for unclaimed property, you wouldn't qualify for this. If you have a balance due on your account, you might not qualify. But most businesses, if you've never heard of this, never done it, you probably qualify for this. And the benefit of this is basically you're coming clean to the state of Wisconsin. You're saying, okay, we got these things that we've never turned over, and the state will basically waive the penalties for not doing that. So you'll get up to speed. How you do this is you apply for this voluntary disclosure program by February 28th, and then the state will either accept that or reject it. And I can't imagine too many scenarios where they'll reject it if you qualify. And then after they accept it, then you have some homework to do. You have, I think, 30 days to try it one more time, try to attempt to find these people. You have to send them like a certified letter, I think. There's a whole, once you do this and you go look at the website, it'll give all the details. So you have to do that first. And then you also have to then file the reports that you didn't file before within a certain number of days. I think it's 120 days. And then you have to ultimately, if you don't hear back from those people, you have to turn the money over to the state. So, but the benefit of doing this is you're not going to get penalties versus if they come and audit you for this and find a bunch of stuff that you've never turned over, there's some substantial penalties on this kind of thing. So we just want to make sure everybody's aware of, what this is, this unclaimed property thing, and that there is this voluntary disclosure program, which is still available through February 28th. So we encourage everybody to consider that. And with that, I think we are done. We're just almost at an hour here. Kristen, if you would confirm, I believe these slides will be available either on our website or available to the attendees after the fact. Is that correct?
Yes, thank you, John. I will be emailing the slide deck along with a link to view the recording at the conclusion of the webinar today. So that will be sent to the email address you used during registration.
Well, we really appreciate everybody joining us today. So we hope
Thank
you all have a great day.
Yep, that's all I have. Thank you, John, Kent, and Rich. We appreciate you sharing your expertise today, and we appreciate everybody joining us for today's webinar. We look forward to having you join us again in the future. Thanks, everybody. Have a great day.
All right, thanks.